the head of the DMO, joins me now. Welcome. Thank you very much indeed for coming in this morning. A Herculean task you have here, a very difficult job. You have to sell £187.3 billion of gilts next year. How do you go about doing that?
Probably very much the same way we've done that in this year, which is just finishing, where we actually had an even higher financing requirement, which was over 200 billion. And we're using very much the same structure that we did then, which is to have a core focus on an auction program, which we're supplementing with what we call syndication, where we use a group of banks to help us sell bonds, and also certain smaller types of auctions that we refer to as mini tenders.
Now, there is a lot of uncertainty in the UK. Obviously, we don't know what's going to happen at the election. There may be a hung parliament, although I gather that that's already priced in. The Bank of England may stop buying gilts and buy less of them. What do gilts offer investors? What are you selling here?
Well, they are effectively the government, the central government's debt, and as such represent sovereign credit risk at its very best, and the UK sovereign credit risk in its wider sense. They are the benchmark for the market. They represent the UK government's debt denominated in its own currency, so they're clearly the #1 attractive fixed income investment in the UK.
And was there anything in yesterday's budget that will make those gilts easier or harder to sell?
Well, I think there was a sense, although the market had, I think, begun to discount it, that actually the borrowing figures were coming in perhaps slightly better than people had foreseen just a few months ago. I stress slightly. Yeah. This is indeed still a very large financing requirement, but I think that some people have drawn an element of comfort from that, and they're not out of line with market expectations.
Now, what about the ratings agencies? They don't have very many positive things to say, and in fact, I think Fitch today looked at what Alistair Darling had said in his budget yesterday and still said that it was a very fragile path to recovery, and there could still be some shocks along the way.
The rating agencies ultimately will decide themselves what they intend to do without necessary influence on our side. What I would say, though, is that the market will probably usually anticipate any move by the rating agencies well in advance. They tend to be perhaps more of what one might describe as a lagging rather than a leading indicator. I would say that whatever the rating agencies decide to do eventually, and I'd be very surprised if there's anything that's done this side of any election, that the chances are that the market would have already priced that in and would have already taken that very much in its stride.
If it did look like, very seriously though, look like the AAA rating was going to go in the UK, that would have an effect, wouldn't it?
It's hard to say. Again, I think that if that were to happen, and I would like to stress that I do not expect that to happen, but if it were to happen, my guess is that the market would have already priced that in. So I would tend to think that it would be very much what you see in markets, very much a sort of buy the rumour, sell the fact situation.
Right. Now, you're obviously in touch with your foreign investors. What are their biggest concerns about buying UK debt?
I think clearly, because we issue debt in our own currency, the currency itself is a very major factor. But I always like to point out that just because the currency is necessarily firm during one period, or perhaps less so during another, doesn't really affect investor behaviour that much. At times, actually, a slightly lower currency seems to entice more foreign buying.
OK. Thank you very much indeed for coming in and sharing those thoughts with us this morning.